Hey there, Rockstar. Matt here from Epic Real Estate, and welcome to the Epic Real Estate Investing Show, where we show people how to invest in real estate so they can escape the daily grind and retire early. And today we're going to talk about how to invest in multifamily properties. We don't do that very much here, but I know a lot of you are interested. I've heard it and I've seen it. And so, you know what? I think it's a good time to start talking about it. And we'll even cover how you can do it with no money, because that's my favorite way to do real estate. So we're going to cover that today with our special guest. But before I introduce our guest to you, just a quick heads up tonight, actually just a few hours from now, getting together with a group of investors to go over the highlights of last weekend's. On Saturday, we did this 9-hour virtual workshop, flip the script workshop, where I and my expert friends, we shared how to pivot, plan, and profit in a recession. And bigger profits available in a recession is what most people actually discovered. And they learned how to adjust their approach so that those bigger profits could be theirs. So I'm going to do my very best here to summarize the best of the best stuff in a 9-hour live workshop. I'm going to try and condense it all into 60 minutes, give you the best of the best stuff. Okay. So we get started actually in a few hours. So if you want to join us, you'll see a link down below in the description. And it's totally free, by the way. Okay, so the link is in the description. All right, so today, my guest has been investing in real estate for over 15 years now. He started in single family, small multifamily properties, and eventually working his way up to large 100 plus unit multifamily buildings. And before entering into those large buildings, he had wholesaled over 200 single family properties. He fixed and flipped over 150 also, and developed and completed several new development projects, over $20 million in ground up construction. Got a ton of experience. And he also started and built a construction company, bringing in over $30 million in yearly revenue and growing. He's now an active and passive full-time multifamily real estate investor. And his company, Elevate, currently has 5,812 doors and $325 million under management. So those assets are located throughout Texas, Oklahoma, Georgia, and South Dakota. And now he dedicates a big portion of his time helping others follow in his footsteps to duplicate his results. So please help me welcome to the show, Mr. Jorge Abreu. Jorge, welcome to the Epic Real Estate Investing Show.
Thank you, Matt. Excited to be here.
Yeah, nice to meet you. I see that we've got a ton of mutual friends, although this is our first time ever meeting. And so I wanted to talk to you about that. And, I'm curious, is I know a lot of people here that watch this show, they're getting their start or they're looking for ways to get in and get their start. Did you start with multifamily? You kind of said you started with single family and you moved your way up, right? And I'm wondering why you did.
Correct.
Yeah.
I went all in on the single family. Started doing it full time. That was about 15 years ago, and I wanted to scale. I wanted to do very high volume and grow the company. And I kept hitting some brick walls with the single family in doing that. One of them was finding good contractors, and that's why I brought that in house. And that helped for a bit, but I was only able to do so many. So when I got introduced to multifamily syndications, kind of blew my mind, because before then I thought, okay, well, these investors that are buying these apartments, I mean, they must be coming in with millions of dollars. But then when somebody explained to me, well, you can syndicate that and you can bring in other investors to come partner with you and purchase the properties that way, I was sold.
Got it. Cool. I made this. I've had up to 300 single families at one point. I have a lot less now, but I maybe it's kind of the same thing that you had. Was you're thinking like, well, I got all these properties. Look at a multifamily; it's just a bunch of properties under one roof. Like it seemed like it was an easy transition. It seemed like it was going to be easy for me, and I got my ass handed to me on my very first deal. So it was more than just a bunch of single family houses under one big roof, right? And so if I were to do it all over again, I know what I would do. If you were going to make that transition all over again, what would you do?
My first one wasn't that easy either. It was 37 units, and because of that size, we weren't able to have the on-site staff. So I had to be very hands-on. I learned a lot through the process, but I would start with 100 plus units. I know it sounds like a lot, especially if you're coming from single family, but just the fact that you can have the on-site staff and with 100, maybe 80 units, but I like to say about 100 units, you can support one in and one out. So somebody for maintenance, and then somebody for leasing and managing the property. That's definitely one change I would do.
Got it. Yeah. So 100 units. You start with 100 units. You would start bigger.
Yep.
Even though the first one was a struggle, you think 100 would be easier, or it would they're both equally a struggle, so you might as well go big.
Yeah, I mean, it's a lot of the same amount of work, and honestly, I think the smaller units is more work.
I see.
Yeah, you got to manage on the bigger units. You're managing a staff versus actually managing the property. And there are some property managers that will manage those smaller ones, but it becomes hard to profit those sometimes.
Yeah, I learned that the hard way.
Yeah.
Also, I learned to well, what my lesson would have been was, and I didn't necessarily experience this on single families, but on the multifamily, when it comes to rehab, just come up with your budget and double it is how it came up for me. You got to plan to double it, because we just got one thing after another, one surprise after another, and got nickel and dimed all the way till we're like, wow, we went right through that budget. We needed a brand new one.
Yeah, that's only gotten harder now with the supply chain issues
Yeah,
and COVID.
Mm-hmm. So speaking of the supply chain of the market, what do you see in the real estate market, and where are you directing your attention right now?
There's still very high demand for housing in general. We're able to increase our rents on most of our properties right now with quite a bit of ease. I don't think that's gonna last. It's definitely not gonna last at the rate it's been going. I mean, we've been averaging probably 15 to 20% rent increases on our portfolio. So we're definitely not projecting that on any new acquisitions that we're looking at. But the hardest thing has been dealing with the debt and what the market has done to financing these deals. It was before you could get really attractive loans. Now they've tightened up quite a bit. So we're having to get a little more creative on our capital stack, and our the amount of money we're having to bring to deals is increasing. But I still think there's good deals out there. I think there's going to be more popping up. There's going to be possibly with these adjustable rates, some operators getting into trouble and needing to sell.
Mm-hmm. What are some of the creative ways you are using to fund your deals right now, since the rates have increased?
Bringing in private equity. We've got some institutional money that we've got relationships with, and using that to kind of fill that gap between the common equity, the debt, and just putting in that institutional in the middle.
Got it. So to stay congruent with the subject of the show, if someone wanted to get started in multifamily and they were short on funds, what would be the best approach or the most effective approach for them to take?
So the thing that surprised me about multifamily, and I didn't know that getting into it, was it's really, especially the syndication, multifamily syndications, it's a team game. Like, there's a lot of partnerships going on. Most of our deals, we've got some partners in there, whether they brought us the deal or maybe they helped us with some of the equity and whatnot. So if you're starting out, I would say you need to pick what you're really good at. If it's finding deals, then go out there, find some multifamily deals. And if you bring that to another operator, they can pretty much do everything from there. They can sign on the loan. They can, at least I know we can. We'll sign on the loan. We'll bring the equity. We'll do everything else if you can bring us a deal. Same thing with if you're really good at raising equity, or you think you might be. You have a network that you can tap into. You can bring that to other operators or syndicators and let them know, hey, look, I think I can raise $1 million or $2 million. How can I help you on a deal? So that would be one way to get into a deal without any money, right?
Right.
Your own money.
It's really no different than single family when it comes to that, right? It doesn't take any money to find a deal. And when you have a deal, there's typically no shortage of funds that are willing to participate in it, right?
Pretty much, yeah. I mean, I wouldn't say, I hear a lot of people say, find the deal and the money will come.
Yep, I say that all the time. I've been saying it for 15 years.
Okay, so
yeah, let's talk about that.
I think to a certain extent, right? You need to plant those seeds and have those relationships, obviously. That's the only part I wouldn't skip over, because I do see some syndicators kind of skip over that and think, oh, if I get a deal, it's just going to come.
Well, I'm not saying it's just going to start falling out of the sky, right?
Right.
But I mean, if you have a deal that makes money, then there's a lot of people out there with money that want to make money that don't have deals, right? And so all you got to do is share your deal with somebody.
But it takes a little bit of time to, at least with us, to feel comfortable with that person and go into a partnership with them. So all I would say is, start planting those seeds before you even have that deal.
Well, if I had a deal and we just met, could I just wholesale it to you like I wholesale a single family?
Not really. I haven't bought one multifamily apartment from a wholesaler.
You can't do that? You're saying you can't do that?
You can, but it's a lot harder with multifamily. The contracts are not simple. The terms that you're agreeing to vary quite a bit. So things would have to align pretty well. And a lot of the times it's weird. They say they're wholesaling a deal, but they don't even have it under contract. They know somebody that knows somebody.
I'm not talking about that guy. I'm talking about the one that does have it under contract.
So if you do have it under contract and
it's going to make you money, then you could do that, right?
You could if you set it up right. Absolutely. Absolutely.
Sweet. So let's talk about like what a deal is, because really what the caveat there, when I say frequently, and I say it ad nauseum, that if you find the deal, the money will find you. All right. But then I always follow it up with, if you can't find the money, it's for one of two reasons. Either you didn't share it with enough people, or two, it's not a deal, right?
Correct.
Right? I mean, I've never had a deal that was going to make money that had equity or was going to cash flow nicely, that there wasn't money available for it. And I'd have to believe if you shared it with enough people, even if it wasn't you, Jorge, that you do a little bit more investigating on who you're buying it from. There's plenty of people out there that were ready. I mean, there's people watching on this channel right now. They're like, how do I get in? How do I get in? If you got them a deal, they're going to try and make it happen, right? And by the way, if you'd like, while Jorge's here, I don't talk about multifamily a lot here. So I'm trying to compare the two, and I'm trying to pull this out of him. But if you have any questions for him, type them in the chat, because I'm not your multifamily expert. I know how to do it wrong. I've done that a couple times, but I haven't done it right yet, and I haven't tried again to do it since I messed it up. But so that's my context. Either you haven't shared it with enough people, or it's not a deal. But I know with multifamily, there are a bunch more variables that constitute what a deal is. Like for a single family, I just need to get it at a low price, or I need to have a great cash flow position. I can typically find the money with no problem. But it's, as you were alluding to, probably, that it's not that simple with multifamily. So what makes a multifamily property a good deal?
Yeah. You took some of the stuff I was going to say right there. Single family, it's pretty straightforward. If it's a good deal or not, you look at the comps, you look at what you're buying it for and what you need to put into it, and it's a deal or it's not. And multifamily, there's so many different variables, like you said, that you can pull on and play with to, on the high level, make something look like a deal. But once you dig into the underwriting and the assumptions that are being used for those projections, that's where it gets tricky. Because I mean, you change an exit cap rate and you can take a horrible deal and make it look like a good deal. You put some rent growth that isn't feasible into your underwriting. It'll look like a good deal, but it's not really. So it's all on the assumptions that are made on the pro forma, really. And if those are realistic assumptions, and then the returns that it's spitting out are in line with what you're looking for your investors. So, we're usually looking for 16% or above on the IRR, and most of our deals we're going to project them 5 years out.
Right.
Correct. Or 20% annual return, or pretty much double an investor's money in 5 years is kind of like our standard that we look for. So if a deal is hitting that and the assumptions are realistic, to me, it's a deal.
Okay. So if you're looking at a deal, I see all the great questions, and I'm gonna get to all of them. Okay. Thank you for participating. I appreciate it. When you are looking at when a deal comes to you and it looks good on paper, what are some of the more common ways that you discover to be the deal breakers as far as where people fudge those assumptions?
Yeah. I mentioned some of those. So the exit cap rate, which is what's going to give you your value when you sell, is one that's easy to adjust. Your rent growth, which I also mentioned, your expenses at the same time. Like if it's not accurate expenses. Let me think what else. Your debt is going to play a big part. I talked about debt earlier. If you're putting in assumptions on your debt that you just can't get in the market right now, then obviously that doesn't make sense. Those are probably the major ones. I mean, there's a lot of other,
Well, then it's not too different than single family.
Yeah.
Right? Okay.
Right.
Cool. All right. So everybody wants to know, okay, we're talking about what constitutes a good deal, but how do we find one? So let's see. I got a couple that there. This is Generique Name. Is that French? Oh, it's generic name. Got it. Asking for tips to find multifamily deals, best locations to buy multifamily. So how do you find your deals?
How do we find our deals? Okay, so I'll tell you how we find them, and some of that is our track record helps. The fact that we've closed a lot of deals and people know who we are in the multifamily space. So we get a lot of referrals. A lot of referrals from brokers, a lot of referrals from other investors. That's how we get the bulk of our stuff now. I will tell you, in the beginning, we brought over a lot of the stuff from single family. We cold called. That's how we got our first 2 deals. We sent out letters. We didn't have a lot of success with that, but I feel like we could have, if you really want to target something and just send it over and over and over, you could maybe have success with that. And then building broker relationships is really the main ones. There's other, like maybe building relationship with some of the vendors in the multifamily space, whether it's property managers, attorneys. They can also refer you some business.
Got it.
And I think they asked about locations as well.
Yeah, there's some locations that are better than others right now.
Yeah, I mean, absolutely. Especially with the market softening, you definitely want to be in a good, strong market with strong fundamentals that has population growth, that has job growth. And I know I'm saying really generic stuff, but I mean, you would think it's common sense. And then landlord-friendly states. I mean, I don't pay any attention to the others. Just too many variables that I can't control in the other states. So we've had a lot of success. I'll give you one tip here. So we'll find a city that is experiencing a lot of that growth, but is really hot, right? The market's super hot, hard to find a good deal. Well, we kind of go on the outskirts of that city and find the ones that are growing with it, right, from the expansion, and then get a good deal there. And we've had a lot of success with it.
Sweet. East of Mississippi has the highest returns. What do you think?
I don't know about that. I don't. I would say I don't know enough. You know, I would have to look into it. I haven't looked too much into Mississippi,
Let's
but
see. No, I
I would
said
be
east of the
surprised.
Mississippi. This is east of the river, right? This is what I imagine she's saying. Thanks for the question, Jay. But you are in, well, you are in Georgia. So are your Georgia properties doing better than your Texas properties?
We exited that Georgia property and we did pretty darn good. We more than doubled our investors' money in 1 year. So maybe that's right. I don't know.
Okay.
We've got
There
one
you
in
go.
South Carolina right now that's doing really well as well.
Go ahead. Jay's got the tips. Here's another question. This is a good one. A lot of people think about this, but this is probably even a bigger question with multifamily. How do you calculate the repair cost on multifamily without being there? Do you have a quick and dirty math formula, or do you have to actually go
Without
there
being
and
there.
get it done?
No, I mean, I definitely am able to guesstimate by looking at pictures and I'll tell you this, the renovations on multifamily is a lot more straightforward than single family. You know, you're looking at the same deferred maintenance wise, you're looking at your roofs, your exterior walls, your concrete, um, foundation, plumbing, electrical. So I mean, it's the same stuff over and over and over.
Right.
As far as a ballpark number and how to look at it roughly, I mean, we usually do somewhere between 5,000 per unit to 10,000 per unit, just depending on what condition it's in, how old it is.
So you can essentially just
Yeah,
evaluate one unit and kind of multiply that across, and that can get you pretty close.
for sure with the interior units, and then you just got to throw in some of that deferred maintenance on the structural and
Deferred maintenance, and then some of the common area stuff and
yeah.
the shared utility stuff like that. Sweet. All right. So, what are you most excited about right now, heading into this unforeseen territory that we are with this market?
Yeah, I'm excited about, and I hate saying this, but I mean, look, it's we've been on such an up and up with this market, right? And um, we've been leaning a lot on our track record and relationships. But now with the market kind of turning, we're actually able to negotiate and really hunt some of these deals. And I just really enjoy that. So kind of looking forward to that. You know, I've already seen a lot of buyers drop off, a lot less buyers for some of the properties that we're going after. So I feel like now's the time to really get in at a good low basis and then experience it on the way back up.
Right. Right. No, I'm noticing it already in my office too. I've been noticing about 6 8 weeks ago. Just the conversations from sellers were different when they were just like my price or the highway type conversations that I've experienced for so long. All of a sudden, it's like, well, tell me more about that creative financing thing you got going on over there, right?
Yeah.
Where there used to be this, they'd be like this on to me on the phone and not wanting to hear anything. But yeah, I'm seeing that type of opportunity. We just did a workshop on Saturday and spent 9 hours discussing how we're going to pivot in this new market and how the new plans we got to make and how we're actually going to generate profits. And that was a really great workshop. And by the way, we're doing in a few hours, we're doing a recap of that. I'm taking 9 hours, pushing it into 60 minutes. If you'd like to join us, I'm going to go as fast as I can, but give you the best of the best stuff that we cover on Saturday just to prepare yourself for this new market. And whether that's single family or multifamily, as Jorge is saying, the link is in the description below. There's a little Zoom link. So there is, let's see, Jay's got a question here. And this is good because I think we as real estate investors, when we're talking and publicly, we kind of take for granted that everyone knows exactly what we're talking about, right? And I think we hear the words like cap rate thrown around all the time. So can you please explain compressed cap rates? I'm not sure even what that means. So you have to educate me on that. Like Las Vegas is 4 to 5 units in bad neighborhoods are trading at 6 caps. So let's talk about what a cap rate is first, and then let's answer Jay's question specifically.
Yeah, so a cap rate is the way the values are determined in multifamily. So in any given market at any given time, you have the going cap rate in that market. And that's telling you essentially what that property, from day one, how that property is performing. So the higher the cap rate is going to be, the lower the price, the lower the cap rate, the higher your price. because you're going to take your net operating income and you're going to divide it by that cap rate. A compressed cap rate means that they're shrinking and the values are going up. So we were getting a ton of compressed cap rates. People buying deals at 2% or 2 to 3%, which buying that deal, that means that it's not really producing much of anything as far as cash flow. So hopefully you've got a plan to add value, and that's how then you get a stabilized cap rate that's higher. But yeah, especially in the Class C. So I'm not sure if everybody knows Class A, Class B, Class C, but your Class C is usually your 1980s and older properties, and then 1980 to 2000 is your Class B, and then 2000 to now is a Class A. Not that simple, but something like that. Usually your Class Cs have a higher cap rate than your Class Bs, but as the cap rates were getting compressed, the Class C was getting closer to the Class B. So that's why they're saying, these bad neighborhoods at a 6 cap, I'm sure those are C-class properties, maybe even D-class properties. So those are the ones, we've really started kind of staying away from now, just because we feel like it's going to expand. So if the cap rates start going up, we call that an expansion. Yeah, I'm not sure if that explains it, but
yeah, I mean, you explained it pretty good. I get it. I understand now. So the C and B properties are kind of selling for the same rate, the same price, but you're gonna have a totally different experience, right?
Pretty much.
Okay.
Yeah. So we're doing a lot more Class A now and some Class B. We still got some. I'll still go and buy Class C. I really want to get it at a low basis.
Is it the neighborhood that makes it a Class C, or the condition of the property?
Right. So I split it up in 2 different ways. I consider there's different class of location and different class of property, because you could have a Class C property in a Class B location, which actually is ideal, because that means you can pour money into that Class C and bring it up to a Class B, right, condition-wise.
That'd be a good situation.
Yeah.
Cool. All right. So yes, explained it. Jay, you in Vegas? Let's connect. I don't have any investor friends here locally, but we're marketing here, so I'm trying to do deals here. It's been a long time since I've been able to do deals in my own backyard. So when I moved here a few years ago, then we started going. But it's a different type of market. I have no problem doing them in the Midwest. No problem in the South. But it's competitive on the coast, and here in Vegas more especially. Let's see. She's asking, do you recommend staying out of Vegas? LA, San Francisco, New York City?
LA, San Francisco, New York City, absolutely. I wouldn't touch it. Vegas is different.
Wouldn't touch it. Okay, that is the most convicting statement that you've said yet. Why wouldn't you touch it?
I mentioned landlord-friendly states. That's where we focus. LA, San Francisco, New York are not landlord-friendly.
You want to stay out of Oregon, I heard, right? It's statewide rent control now.
Yep. So Vegas has been a good market for multifamily. I personally haven't done anything there, and I would have to dig in a little further, but I do know other investors that are pretty active there.
Sweet. All right. Well, cool. So in your business right now, what do you need most? What are you missing?
What do I need most?
How can we help? Maybe the community can help you.
Yeah, we're always looking for co-GPs or partners that can bring equity to our deals.
What's a co-GP?
So in a multifamily syndication, you have general partners and limited partners. So usually the ones bringing the equity are just limited partners, silent partners, in other words. And then your general partners, which are the active ones running the deal. So general partners that can bring some equity to our deals. We've got a lot of deal flow, a lot in our pipeline, so we can always use help on the equity.
Okay. So if someone came in with some equity, what would they expect to receive in return?
So we break it down. lot of different responsibilities. So we don't want somebody that's just going to bring equity for SEC that doesn't quite line up with their rules and regulations. So we would want to see what else they bring to the table. When I say that, it could be bringing maybe some of the earnest money, or being boots on the ground, or playing some type of active role in the asset management of the property once we close on it. So it would just vary. I mean, I would say anywhere from 5% of the general partnership to, I don't know, maybe, we would at least like to have 60%, so maybe 40% max, depending on what they're bringing.
60-40% what? Ownership?
Ownership, yeah.
Okay. So then your big role, you have a piece of ownership, but then you'd be responsible for the management and the production and how the property produces, right?
Correct.
Got it. Okay. Sweet. All right. So let's take one more question, and then we'll see where that leads us. How would you make at least a 15 cap in Vegas? Because they're not found, they are created. So yeah, what are you looking for? Like, what are the big opportunities that you look for that you can increase the cap rate?
Increasing cap rate, there's so many ways, to add value to a property. One is renovating the interior units and asking for more rent, bringing the existing rent up to the market rent if it's under it, adding units if there's any way to, take over. We've taken over office space before, or units that are just being used for storage, and put them back online. We've adding carports and charging for the parking spaces, implementing internet, and getting a profit sharing from providing that internet to our residents, lowering expenses, figuring out ways to lower the expense and be more efficient with it, is a big one.
How big of an impact does what I hear all the time, like vending machines or the laundry room, adding storage facilities?
Storage, yes. Storage is a big one. If you can figure out a way to
powered billboards on the roof.
I haven't done billboards. I know some properties that do have them. I would say laundry is you need to make it friendly to your residents and want them to use it and make sure it's clean.
All this time I've been putting in angry laundry rooms, and that's why I lost. What do you mean friendly laundry room? What does that mean?
Oh man, I'm just thinking a lot of the Class C properties. Like you don't want to be in the laundry room. It's just it's hot, it's ugly. So making it inviting and
safe, comfortable,
safe,
right?
inviting, clean. Yeah.
Of course. All right.
Vending machines.
Nah.
I think maybe it depends on what class. Maybe on a Class A, and depending on what type of vending.
I think
products you have.
I would think parking and storage would probably be your biggest bang for your buck, right?
Those are pretty good, and stuff that's already getting done. Like I mentioned, internet. Your residents are already paying for internet. You might as well help them, and you actually get faster. You get them better deals, faster internet for cheaper than they can get on their own. So,
what about appliances? Is that a profit center?
It is. Washer and dryers can definitely be. If you have the hookups and then you provide the equipment, having the hookups alone is also another income. You can charge just for having the hookups. And then if you supply the equipment, you can also charge for that. So yeah, that's a good one.
Sweet. Well, Jorge, it's been a pleasure. If someone wanted to get in touch with you, what would be the best way for them to do that?
Yeah, we have a ton of free content and information on our website, which is Elevate CIG, stands for Commercial Investment Group. So elevatecig.com. And then if they want to go ahead and email me, it's Jorge or George, JORGE at elevatecig.com. And I can send them a email with a bunch of free content as well.
Sweet. All righty. So yeah, I've got a huge single family creative finance audience here, and but a lot of them ask me questions about multifamily all the time, and I just have to defer to the experts because boy, you don't want my advice on it. In fact, any advice I give you on multifamily, do the opposite, and you'll probably be just fine.
There you go.
Anyway, Jorge, I appreciate you. It was nice meeting you, and let's do this again. All right.
Awesome. Thank you, Matt.
You bet. Take care. All righty. So one last time, if you'd like to join us for how to pivot, plan, and profit inside of the recession. So there's actually more opportunity now than there was in the last several years. If you know how to find it, you know where to look. If you make some little adjustments to your strategy. I did a full 9-hour workshop on this for a group of investors on Saturday. We recorded it, thankfully. So they have the recordings. But what I can do is, if you like, and here in a few hours, we're going to compress 19 hours of the best stuff from there. And I'm going to do my best to get it to you in 60 minutes or less. And if you'd like to join us, you can do that for absolutely free. I'll be there, and you can interact. You can ask questions, all that kind of stuff. Link is in the description below. Little Zoom link there, right there for you. And that is it. So if you found this episode valuable, who else do you know that might? There's a really good chance that you know someone else who would. And when their name comes to mind, please share it with them. And then ask them to click the subscribe button when they get here. If you like what you heard today, get the like too. Hit the like button too. Just tells YouTube that we're doing good stuff over here. And then when your referrals come over here, I'll take great care of them. All right. So God loves you. So do I. Health, peace, blessings, and success to you. I am Matt Terrio, living the dream. Take care.